Inflation is sticky, but the Fed decided to leave Fed funds unchanged, and we got earnings from Starbucks and AMD, those two in particular causing some very big moves. We actually had exposure to both of those, and we're going to talk about those and some other things today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic, sponsored by OptionPlay. So very quick and important sort of programming note here, and that is that if any of you watching are interested in reviewing any given security or something like that, please be sure to put that into the live chat. So on top of the normal like, subscribe, and all that, the best way for me to know what you would like to know about or for us to go over together is to go ahead and share it, and then we can go through these things together in real time and address any concerns you have, whether that is about positions that you currently have and you're wondering about, or whether it's just more of a fundamental question. I don't know about every single stock intimately, but I have access to some tools here, and maybe we can work through some of those things together, and you'll find that helpful. If I look a little haggard to you today, I am. It was a tough day for the good guys. We had positions in AMD, we had positions in Starbucks going into these prints. Starbucks, this is kind of an interesting one. So the earnings results on Starbucks, obviously pretty dismal. Just a quick reminder for those of you who held Starbucks and are wondering what happened here. Because this is actually one of the sharpest declines that the stock has actually experienced post-earnings that I can remember. A while back, the company had basically the expectation for the street. They were looking for global same-store sales growth in the 7 to 9% was what the forecast was at one point. Guggenheim had come out with a note, and I think this is kind of important. I'm going off of memory here, but one of the observations that they had made about those same-store sales forecast numbers was that those forecasts were made at a time when inflation, which is also relevant to today's conversation, was running a bit hotter than it is now. Why does that matter? When you're looking at forward guidance for companies, they don't inflation adjust those. They just basically come out with a number. It's a nominal number. And if you see, for example, 5-6% nominal anticipated same-store sales growth, and that happens to be about the rate of inflation, then what you really are getting is a situation where you're not experiencing any real unit growth. You're not selling more cups of coffee if all you're doing is basically selling the same amount of it in dollar terms, and all of that increase is coming from simply from inflation. And the numbers that we got today actually are that we shouldn't anticipate any real growth at all, which means that in real terms, you're experiencing a decline. And that is the reason why the stock was as hard hit as it was today. I suspect that the stock might be a little bit oversold here. In terms of valuation, we are actually at a pretty remarkable place. So I was looking at this earlier today. I happened to notice that the $84 billion market capitalization, $106 billion enterprise value, which is where we find ourselves as of today's close in Starbucks, is approximately where we were about 3/4 of the way through 2020. And the reason I bring that up, obviously, stocks sold off very sharply as a result of the pandemic. We'd already started to experience a bit of a recovery by that time. But while that was going on, we also had experienced significant harm to a lot of businesses that were shut down by pandemic-related activities. So basically, we have a valuation now that is approximately where it was as we were emerging from the pandemic, and at a time when revenues were about a third lower than they are now. So $3.80 a share. That's, I think, what the street's expectation is now for full year 2024. So that would, and that, by the way, their fiscal year ending as it does at the end of September. So that would get you in round numbers to less than 20 times full year earnings. That's a very low multiple for Starbucks. RSI, so the relative strength on this one, suggesting that the stock is a little bit oversold. Actually, I'll just give you that RSI number now, because I think that's kind of interesting. Actually, why don't we just pull this up so you guys can actually see what I'm looking at. Why speak when I can show? So that's the number that I'm looking at down here on the bottom panel. We can see right here. Now we did not adjust our Starbucks positions today. That's not usually what we would do in any case. We usually sort of look to see what happens over the course of the next few days. I think I've referenced this before, trying to get a sense of what real money accounts might be doing in the name before we make an ultimate determination. This was a pretty chunky position though for us. So difficult one if you're in it. Let me know what kind of positions you have. One other observation, I think this is interesting. I might actually have a, see if I can find a chart on this. This is a little bit interesting. So I'm going to actually just take a look at yesterday's volume here. And so one of the things we take a look at, I've been asked this question before, do we ever look at unusual volume? Obviously it traded extraordinary volume today. That's not surprising because of the big move. But let's just take a look at yesterday very quickly. Was there anything we could have picked up on yesterday that might have signaled that the news would be worse than we expected? I often will engage in this kind of forensic post-mortem types of stuff when we get moves like this. And this is what I managed to uncover from yesterday. So I'm going to just filter some things out here. We had above average volume going into an earnings print. That's not so extraordinary. Calls outpaced puts slightly. Okay, that's actually fairly average. If you take a look over in this is a lot of stuff to look at here, but generally speaking, for a lot of single stocks, and that's true for Starbucks also, calls outpaced puts. Okay, so nothing really to read into that either. One of the things that we do is we actually formulate price-weighted probability distributions based on what the options market is implying. So to make things very simple, you just take all of the options data that you can, and you essentially get a distribution of all of the various possible outcomes. And you can weight those, and you essentially can establish, whether options market sentiment is bullish or bearish. And just showing that it's, even when you have this kind of data, it's possible that you just don't catch it in time. Yesterday, the sentiment for this coming Friday actually shifted negative. And one of the traders was actually trying to adjust positions in Starbucks to accommodate that negative shift. Did not actually get, modified the position only slightly, not nearly enough, we can safely say, with the benefit of hindsight. But what was interesting is what I'm about to show you now, which is that if I just take a look at what was trading yesterday that expires on Friday, it's all of this stuff right up here at the top, the top 10 most active options. The highest of these strikes was the 88s, which, by the way, is approximately where the stock was trading yesterday. Okay, so stock was over 88 bucks. But take a look at this. The most active contract was the 75s. And between all of these contracts, that represents about 75% of the total average options volume that you would expect in Starbucks on any normal trading day. So what did we have going into the print? We had a much larger than average implied move. I think we talked about this. I may have mentioned it on Monday, but either on Monday or last week, I had mentioned that Starbucks had an implied move of about 6.3% versus a historical average that was well under 4%. And then as the day progressed, we started seeing some institutional buying of really options that we would normally consider to be completely out of play. The 75 strike in particular, I mean, the 75 strike puts, does this mean necessarily that something's going to happen? No, not necessarily, but those were 15% out of the money as of yesterday. And look at it, we violated that strike. I think that's really quite remarkable. And I think it's one of the reasons why we want to take a look at these things from time to time. I can tell you quite safely that even having seen that, I would not have gone out and chased those. I wouldn't have actually been a buyer of those puts. We did try to just soften up our net long exposure to Starbucks going into this on the basis that the sentiment shift going into Friday was a little bit weaker. But I do happen to think that at the moment, Starbucks is a little bit oversold. I think it looks relatively cheap to its historic. There is one thing I would say, though. Does that mean that I would back up the truck in Starbucks here? The answer to that is no. Why not? Okay, so if it's trading 19 times and the historic average multiple for Starbucks is probably at or higher than the average market multiple, and we're going to just see what this average is. So right now it's trading 18 times forward. The historic average is 23.5-ish. So what does that mean? That would imply that if you were just trading at the average historic multiple for the stock, it would be about 96 times. So on almost every sort of fundamental metric, it looks cheap. Here's something else that's unusual. It's trading cheaper than the group. Now, this group, if you're looking at this list, you can see there's a lot of things on here that you wouldn't consider direct comps. McDonald's, not exactly a direct comp to Starbucks. Yum, Cheesecake Factory, these are all obviously very different businesses, but when you take a look at it, generally speaking, Starbucks is traded at a premium to the group, and now it's trading at a discount. So with all of that said, why is it, and we already have considerable exposure to Starbucks, why is it that I wouldn't add more here? Well, the simple reason for that is that my basic policy about long-term core holdings is that they should be growing at least as fast as the economy overall. So if the economy is growing at 3.2%, and it doesn't really matter whether you say, okay, well, the economy's basically on life support because of huge fiscal deficit spending, that might be true. But at a high level, when companies are not growing at least as fast nominally as the economy, that's just not something that I have interest in having overexposure to. So we didn't sell any today, but that's that. So, okay, let me just take a quick peek. Actually, I also want to just touch on, I'm going to start taking a look at some questions. Oh, we got a question in Starbucks, so we should probably address that straight away. So Alex here. How to get out Starbucks 84 put calendar. Long leg is May 10th. This week's put calendar, long leg is May 10th. So I'm assuming, Alex, that you are in the May 3rd, May 10th Starbucks 84 strike put calendar. Well, let's take a look at that trade. And remind me, because I do want to get back to AMD also, because I think AMD is another one that got very hard hit. Let me do this, okay. All right, so let's just construct this trade really quickly and see what we have. Long the May 10, 84s. Now that one, I mean, it's maybe not that much of a consolation, but it's an important point. When you put these calendar spreads on, you are at the very least defining your risk, right? So the most you can lose, theoretically, is what you spent on the trade. All right? So let's just take a look at what's going on here and what this position actually is. So long the 84 puts, short the 84s. What's the story? The issue you have with this trade is both of these puts are basically trading at parity at this point. the objective normally in a trade like this would be that you have the stock migrate to the strike. That's when you get your peak profits, because the value of the option that you're short, which in this case would have been the May 3rd, let's say we landed straight on 84. At expiration, the 84 put is essentially worthless, right? That expired on expiration date. And the maximum extrinsic value for the longer dated May 10th 84 is also at the money. So that's sort of that sweet spot. And to illustrate this, I'm actually going to create a different trade over here that is in fact at the money. And so we can sort of see what this chart's supposed to look like versus what it now looks like. So stock's around 75 bucks, so I'll buy the June 75 put. I will sell, let's say, the May 31st 75 puts, middle of the range. And here's what that looks like. People, I'm sure you guys have seen this before. And let's also just talk a little bit about the strike you selected, and just for future reference, and what you can do with that one. So this is kind of the ideal situation, right? You buy a calendar spread. You want the stock to be at the strike of the calendar on the expiration date for the nearer dated option. So let's go back to the other trade, the one that we're actually in here, which is this one. Now, this is not really a very informative chart. Why is that? Because both these puts are trading at parity. What is going to happen at this point? You're short the near dated one. You will be assigned if you hold it to expiration. So for every one time you've got the trade on, you're going to be long 100 shares of Starbucks, and you're going to be long a May 10th 84 put against it. What does that look like? Well, what we can do is actually modify this. So I'm just going to say, okay, I know that this is going to be assigned if this is assuming you do nothing. So we kill that. And if you're assigned, what's going to happen? You own stock. So in fact, your actual position is going to look a little bit like this. Well, that's a little bit deceptive, because you're not going to get a standstill rate of return, because, so if I could modify that price a little bit, we could see it. But the gist of it is, oh, I must have tweaked this. I'm not going to make any assumptions about where the stock is going. Let's just say it's right there. Okay. So basically what you end up with is a synthetic May 10th 84 call. If you're long a put and you're long the underlying stock, synthetically that's equivalent to owning that same call. And I can actually just show you that here. So I'm just going to go to May 10th, the 84 strike call. That's if you do nothing at the moment. This is effectively the position you're going to be in. You're going to be in this May 10th 84 call. And you can see here that it's actually not even showing where that P&L kicks in, because it's actually out of the frame, right? You're talking about the stock going up 10%, and without a catalyst to propel it there, and we just had the catalyst, that was earnings. The chances that it's going to do that are very, very slim. So what to do? Well, first things first, you can't really fix this trade per se. I would actually just say try to get out of the thing. You might be able to put it into a complex book and get a minor credit for it. It looked like the mid-market price was there. We had this situation in AMD today, actually, where we were rolling out some deep puts, and it was actually surprisingly a little bit of a bid for them still for those calendars. So that might be something that you could contemplate doing, is just trying to unwind it for a very small credit, because that's all you can hope to get out of it at this point. Or you could just allow yourself to be put the stock, and synthetically you own that upside call at this point. The thing is, I don't really think that strike is in play. And if somebody said to me, okay, you can essentially own that 84 strike call for next week, or you could roll it down and have some kind of a call spread, or maybe put on some kind of a call spread risk reversal, where I own an upside call spread. Let's put something like that in. Because one of the other things that's happened in a case like this, unsurprisingly, you get quite a bid for volatility, right? Because this thing's just moving all over the place. So you can actually, and this actually is something that might be applicable for those of you who are kicking it around and saying, oh, maybe I'll do a little bit of bottom fishing here. Dangerous exercise, by the way, trying to catch a falling knife. But again, what I was indicating here is that I just happen to think that this thing might be a little oversold. Like I said, we didn't buy any more of it. Can't really kind of totally full up on this thing already. I don't think you guys want to know how much of it we own. I don't want to know how much of it we own. It's a lot. So let's see what we can do. If we go out to June, give this thing a little bit of time to play, or even to the end of May here. So add a short put. I'm sure a lot of you guys have seen this kind of circumstance before. By the way, stock recovery. I'm going to talk a little bit about that one in here as well. Kind of a dearth of strikes, looks like. So you can end up with a structure that looks a little bit like this, right? Short the 70s, long the 75-80 call spread. This one is indicating that you can actually get this May 31st one off for a small credit, actually get paid 38 cents. Worst case, you're along the stock, 69, 60-ish, round numbers, get a little near side upside participation if you want. Okay, so that's, oh yeah, that's a good idea, sorry. Let me, I keep forgetting to do this. Thank you, Producer Jay, for reminding me. So I'm just gonna drop this thing into the chat. You guys will have a link to it. Where did I put that in? Did it go in? Okay. All right, so if you look at the live chat, you're going to see that. You can click on the link. If you have the OptionPlay application already, you can get that trade in. You can play with it, do what you want. If you don't have an OptionPlay subscription, you can click on the affiliate link, and you can sign up for a free trial. You can be able to play with it that way, which I recommend. Okay, what do you do if you own the stock? It's broadly held stock in a case like this. So sometimes what people will do are something called stock recovery strategies. It's highly unlikely that the stock is going to get back to where it was trading anytime soon. That's just the sorry reality. So if you're hoping to recover some of your gains, you say to yourself, well, I'm long the stock, don't want to blow it out. I don't want to take on more risk, though, for the reasons that I just articulated. Why don't we want to take on more risk? There's no growth. In fact, actually, flat growth is negative growth when you adjust for inflation and you adjust for the growth in the economy. If you're adding stores, and you incorporate inflation and your sales growth is flat, you're actually shrinking. It's not. That's the reason the stock was so hard hit today. Okay, so you own the stock. And you want to get a little bit of upside juice. One of the things you can do is do a ratio call spread on top of it. So I'm just going to add the stock here. What does that look like? I'll go out maybe to June regs, just give myself a little bit of time for this to play out, because I certainly don't think the stock's going to actually recover back above where it was. I can buy these 75 calls, and I'm going to go and try to sell a couple higher strike calls. The hope and objective in a case like this is that I get a little bit more juice to the upside than I would by getting the stock. So as you can see here, this is sort of the equity line at a 45-degree angle. And what you can see is that up until that 80 strike call that I sold, I'm actually going to be pretty close to doubling the rate of return that I get. Now I'm capping what I get there, but it's not a situation where the stock's going to get back to its prior level. So if you're sort of comfortable with that notion, this is a way that you can use some upside calls to help finance some lower strike ones and give yourself a little bit more of a boost at lower levels. So I hope that that's helpful. Okay, AMD. I was going to talk about AMD. Another big position we had. This is a really different situation. If you had told me how the stock might respond to the company's results today, I don't think I would have expected quite the kind of washout that we got. Why is that? Numbers weren't spectacular in every respect, but they have supply constraints, right? So this is a very different situation than Starbucks had. And what I mean by that is if you have supply constraints, so you have unmet demand. So somebody says, oh, okay, well, you sell widgets, and we were hoping you were going to sell 1 million widgets over the last quarter. And you end up reporting that quarter, and you sold 800,000 widgets. Well, at first blush, that seems like a bad thing. It's a 200,000 widget miss. But if I tell you that the reason I sold 800,000 widgets was because that's all we were able to produce, but we have orders for 1.2, well, the demand for your product is there. Your ability to meet that demand was a problem. NVIDIA had this problem, by the way. So it's a good place to be. AMD has a meeting coming up next week, by the way, on the 8th. So we didn't adjust, I think we did a minor adjustment on the AMD side, but we certainly didn't reduce net of today's decline. So let me just confirm that event. So that is indeed, yeah, let's take a look here. Let me get everything. They have shareholder meeting, I'm pretty sure. Yeah, so their annual general meeting is noon. Looks like it's noon my time, Pacific time, on the 8th. And I don't think they're going to be telling us a bad story. So yeah, the other thing I think that's important to remember is that AMD's chips are being used in a couple contexts. Why had the stock been doing so well? I mean, up until its most recent slump, of course, but why had the stock been doing well? What was everybody playing off of? They had really been talking about the AI opportunity. So I think that AI opportunity does, in fact, remain intact. So not a terribly cheap stock, but this thing is growing by leaps and bounds. Full year adjusted EPS, this is relatively recent numbers, so let's take a look. This should be net of any target adjustments as of today. So that gets us to, 40 times, 40 times full year, that's year ending December 31st. And if they can keep that growth rate up for next year, it's still a reasonable number. I think the general meeting next week, again, that's noon on the 8th. It's going to be pretty interesting. One other, so this is maybe interesting to some of you. We have equity position. We did have some puts as insurance on that, and the sentiment skews positive, actually. So that same analysis I was talking about earlier, the price-weighted probability distribution, here too, it did indicate decent sentiment, probably because you still have that meeting coming up next week. So technically, it's probably a little bit of a mixed bag, but let's see. Yeah, I think we kind of have to wait until the general sales meeting to sort of see what's going on there. But okay, here's an CVS. This is another one that was really hard hit today. CVS. So CVS, this is an interesting case. We don't own CVS. CVS actually, what was the problem there? It was their Medicare Advantage plan exposure. I believe that was the real problem there. So they were experiencing, basically when you're in that business and you start to experience bigger than expected costs, right? So this is one of the same things that was plaguing some of the others in the managed care space. So I'm talking about United Health, I'm talking about Humana. There were some others that had idiosyncratic risks, like Centene Health, which did a lot of the Medicaid, like the contract Medicaid work for the states. They lost a chunk of their Texas contracts, and people thought their Florida and Georgia contracts were similarly at risk. It is, the business comes down ultimately to how much you sell and then what the expenses are against it. And this is where they really ran into trouble. And that is that the costs for CVS came in a lot higher than expected. And let's take a look at what their multiples look like now. And by the way, this is a similar situation. I don't know. This is not a situation where I would race in and try to catch the falling knife. Well, first of all, I've said this many times. Give the stock a few days to breathe, along with yourself, by the way, and try to do a little bit more homework and digest what's actually going on there. I think that's pretty important. You can, of course, try to do things like that stock recovery trade that I was just talking about, where you might overlay your position a little bit. That you don't need to wait on necessarily. Why am I saying that? And that's because oftentimes what will happen when you get these really punishing washouts, normally what happens, earnings come out, and if it's a fairly muted response, you get what we call the vol crush, which is that the options premiums start to get sucked out after the catalyst has come and gone. If you have a really severe move, like the one that we saw in CVS, like the one that we saw in AMD, like the one that we saw in Starbucks, like the one we saw in Estée Lauder, which is another name that got hard hit today. What happens is that vol crush doesn't happen right away. And it's important to try, if you're going to do a recovery trade, to take advantage of that early, because the elevated options premiums are going to create a big bid to those out of the money wing options that you're going to sell to basically try to help finance it. So here again, I'm just going to come up with, we'll just modify, it doesn't really matter. I'll pick this one here. So you're long CVS, you want to sell more options than you buy. That's part of the whole objective here. And stock was 56. You typically are going to do a trade like this out of the money. So you're looking at doing something like the 57.5 line. And, we'll see how far out we get. I mean, and this, by the way, will help illustrate this as well, that when you choose, so that actually there is no 57.5 strike for August, so we're not going to do that. Stay with June. And you try to get to a situation where you can put this trade on for essentially no net outlay of premium. And once again, you're just trying to get this incremental boost. You don't take on additional risk to the downside because you're trying to do this for no net outlay of premium, and you're not buying more stock. You do this trade because you do not believe that it is going to fill this unfilled gap anytime soon. And certainly not before the next event. So if you'll notice, I'm looking at June expiration. The company's not going to report earnings again until August 2nd is when it's expected. So if you're doing a June trade or something like that, you're going to be okay selling premium earlier than that. And then also, not going too far out when you're selling more options premium just gives you an opportunity to be a bit more nimble. I mention that because, let's just go back and modify this trade really quickly. I want to illustrate something. One could be tempted in much the same way that people chase premium in other contexts to say, oh, well, if I push this thing out further in time, I can get, maybe I can find something that looks a little bit more attractive. Like I could take this 55.60 1x2, for example, right? So now I've gotten the 55 strike, right? Even slightly in the money, and I get this kind of a boost. Yeah, that's true. A lot can happen between now and September, though. So selling off that upside is something that you might be comfortable with now in the context of this recent fall off. But just be aware that if you push that out in time, now you're short optionality for probably more time than I would favor. You've got the next earnings. A lot can go on. So try to keep it tight. Just take advantage of the fact in an instance like this, stock plummeted, so there's still a little bit of a bid to volatility, and you're basically selling some of that upside premium to help finance some near upside participation. All right. Let's see what we got here. Okay. When do you close out the Meta trade from Fast Money? Oh, that's a good question too. I've had a couple earnings that really haven't played out that well. This is another one. This one actually started to rebound a little bit, but unfortunately, so here's another really important thing. So a debit call spread and a credit put spread are essentially the synthetic equivalents of one another. To illustrate this, I'm just going to build both, and we're going to, and I'm going to choose strikes that are a little bit closer to the money than this one is, because I think it helps. It's going to be a better diagram using current prices. All right, so we'll just go to Meta here, and I'm going to create a debit put spread and a credit put spread and a debit credit spread of the same expiration and strike. So this is in June, so why not? We'll use June. And I will choose to buy the 440 put, and I'm going to sell a higher strike put. Let's call it the 465, so a nice $25 spread here. Okay. See this diagram? That is the credit put spread. So you're selling the 465 puts to buy the 440 puts. In this case, collecting close to $15. Okay, so now I'm going to do the exact same thing, except in terms of expiration, except that this time I'm going to do a debit call spread. There we go. Now there's a slight difference in the executed prices. Part of that probably has to do with the mid-market pricing of the calls and so on. But these things should actually technically kind of add up to one another. And then there's a little bit of wiggle room on that because you have some carry cost issues and things like that. But in essence, these things should be about the same when you add it all together in terms of their risk-reward relationship. So in one case, you're selling something for about $15. You would need to pay $25 to get it back if the stock stays right here. So your max reward is the 15. And here you're paying 10 for something that could potentially make 15 if it runs through. So your max reward is also 15. So you'll see that these two trades are actually effectively the same trade. And this is an important thing to think about, because if you sell a credit put spread that's out of the money and the stock runs through those strikes, as it did in the case of this Meta credit put spread, time was once on your side. That is, that if the stock simply stayed where it was, you were going to get paid to be in that trade. This is no longer true. My inclination is, therefore, usually if it hasn't blown to its complete full value, to take those trades off as quickly as I can. I actually tweeted out that trade actually was terrible. But the thing is, at a certain point, it may not necessarily make sense to do that. Why not? Because actually, all of the potential losses may have already been experienced. So let's just go back to May and take a look at this specific trade. So we're looking at the 495 forward. So I'm just going to bump these strikes up. Short the 495s and long the 475s. So let's take a look at the risk-reward relationship on this trade and see what that looks like. All right. So this trade right now, well, there's still some money to be had, right? But not a whole lot, right? So the maximum loss in this trade from this point forward per spread is $1.20. Do I think Meta is going to recover to $4.95 by May expiration? No. In fact, actually, the chances that you even experience a profit, which would require at this point, using today's closing prices, stock would have to get to 476.20. So above this lower strike put by at least the amount of premium that's left in it. And the chances of that are very, very low, 11%. But I will admit that in some cases like this kind of begins to look like a teeny option to me. This was a gap, so usually you get more time to act than you did here. But yeah, I mean, you can take it off. $120 is all you're going to be able to get back from that. Let's see here. Did CVS make a profit or... oh, this is a follow-up, I guess, to that other question that I was just taking a look at. Did CVS make a profit or loss? So they reported 99 cents a share adjusted. That was a miss. It looks like on an adjusted basis, the street was looking for $1.31. So yes, they reported a profit on an adjusted basis, but let's take one of the things we really actually need to see. You kind of have to go through their earnings report sometimes because they, let's take a look here. That's what the story was. What will sometimes happen is you could get some below the line stuff going on. Yeah, so they missed, and what did they come up with here? It's not a great picture. This, by the way, there's one other thing I would just want to mention. It's just a general observation, and that is that take a look at what's going on. We get some bad results coming out, and some of them are legitimately bad. Starbucks results were legitimately bad. And you get one of the worst post-earnings results that we've seen in a long time. You get results from AMD, which I actually think were not so bad. And the stock gets taken out to the woodshed. Estee Lauder is taken out and shot. Estee Lauder was already a disaster and has been for some time. But it just points out that in a risk-on market, you often will find that mediocre results are easily forgiven. Good results are rewarded with great price action. And that's not really what we're getting. We keep seeing this again and again, that the news is a little weaker than we expected and the stock just gets taken out and shot. And that just doesn't feel like healthy price action. And by the way, what was the best news that anyone could have hoped for coming from the Fed today, right? The best news that anybody could have hoped for, and I think that some were, was that there wasn't going to be any rate cuts. Nobody was even forecasting that anymore. What they wanted were comments that dismissed the more recent concerns that we've been hearing, which is that the hot inflation data we're getting, the employment data we're getting, might actually encourage further rate hikes. And Powell's comments were, that's not what we're contemplating. So of course the market rallied off of that news. But look at what it's done since. It reversed all of that. Futures are down, 15 handles now? So again, this is not great price action, I gotta say. Okay. Let's take I'd like to see if I can address some other questions here. There's a couple. Google, obviously a widely held stock, so we definitely should talk about that. I'm short 100 shares of Alphabet at 157.5, and I'm long a Sep 20th 145 call. I want to close both positions. Should I close both separately or simply exercise? Oh, exercise long call, or does it matter? Yes, it matters a lot. Absolutely, it matters a lot. Okay, glad you asked this question. No. Don't exercise your calls. The only time you want to exercise calls early is a circumstance where you're trying to capture the dividend. So, or if you have a hard to borrow stock situation and you're trying to capture that, but that's not going to be the case here. Why don't you want to exercise that call early? Because that call should, in theory, still have some extrinsic value, and we can validate that very quickly. So it rarely makes sense to exercise options before their expiration date. American-style options. Obviously, European options, you can't do that. With American-style options, it very rarely makes sense to exercise the option early. When does it make sense to do that? There are two immediate cases that come to mind. One, you're long a deep in the money call, and the stock's about to report a dividend. It's going to go ex-div. So what happens when a stock goes ex-dividend? The holders of records, they have the shares and they're entitled to the dividend. The stock is going to decline by the amount of the dividend on the ex-dividend date. So if I have a $100 stock, it has a $1 quarterly dividend. That would be 4% a year. So admittedly, that would be a very rich dividend, but bear with me, it just keeps the math easy. So on the ex-dividend date, all else equal, the stock is, you're going to get the dividend, and the stock is going to go from 100 to 99. Well, if you own the call, let's say you have a 95 strike call option. Okay, well, the day prior to the ex-dividend, I have a $95 call on a $100 stock. It's got $5 worth of intrinsic value. Call options do not get dividends. Only the holders of the stock get the dividend. So on the ex-dividend date, as I just articulated, all else equal, the stock trades 99 bucks. What's that call worth now? Intrinsic value of it is now $4. So if you have deep in the money calls and you ride them through an ex-dividend date, that can be a problem. If you don't know how to exercise a call early, don't worry. The easy thing to do is just go out and sell it. Now, in your case, this viewer is short 100 shares of Alphabet and is long the September 145 calls. So let's put that in. But the first thing I'm going to do is just put the September 145 calls in. And by the way, for those who are following this at home and wondering what the story is, long a 145 call in short stock is synthetically equivalent to being long the September 145 put. All right? So if you want to trade this with the stock, you could trade it together where you're buying the stock and selling the call. I'm going to short this, okay? And what you should end up with is an amount of money. So the 145 calls, because let's take a look here. And actually, this is another interesting thing too, because now Alphabet is going to have a dividend, right? So that was the big news. They're going to have a dividend, and the first X date for the 20-cent dividend is on June 10th. So this is a deep call option. So what you would look to do is sell this call option and buy your stock back. You can do that in legs, or you can do it as a package. There may be a little bit of extrinsic value. So to the mid, let's take a look. 25 spot 33 on the 145s, right? Versus 163.86 stock. In fact, actually, where was this thing bid? Let's see, where was the bid for that call? $25. Well, that's under, right? Or is it? No, okay. So 145 plus 25 is 170. So there's still a decent amount of extrinsic value, even on the bid. So you definitely don't want to exercise that, because what you're going to be doing is giving away all of that extrinsic value. You definitely don't want to. And you should be able to get a little bit better than that. Let me see what that put is worth. Because remember what I said, if you are long that deep in the money call and short the stock, synthetically you hold that put. Now, like I said, there's a carry cost component, which is related to both the dividend and interest rates. That put, if you were just going to go out and buy that put, so exercising it, you would not exercise, let's see what we got here. So the 145 puts, that's a $3.60 option. And you never want to just give away all of that extrinsic premium. So what do? You can sell your call, buy back your stock. You could enter it as a package, either or. The nice thing about doing the two together is you're not going to have any delta risk, which means that you have some concerns about, I execute my call, and then while I'm trying to execute my stock, or the other way around, the stock suddenly moves. But I don't really think that's a big deal with Alphabet. But the short version is, if you ever have doubt about whether or not you should exercise an option early, and you don't have a complete handle on the math, you're almost always going to be better off just lose the option, sell it. Go out there and sell it the best way you can, unwind the position. I've heard people say about options positions, or any position, frankly, it's okay to be wrong. Make a play going into earnings, think the stock's going to rise, it falls. It's not okay to be confused. If you have a position that you no longer completely understand, it's probably best that you don't continue to carry it. And that's because there will always be somebody who gets it, who really understands it, and they will take advantage of it. And options traders, we would spend a lot of time modeling these kinds of things. If an option was early exercise, we would do a lot of call spreads going into dividends, trying to basically capture, do dividend capture trades, because we didn't have exchange fees. You don't want to be on the wrong side of that. So short version is, I think you just ought to try to take that out. Okay. Let's see. No, there's some other. Apple. Hedging Apple into earnings. So Wesley Yee asks, can't watch live today, so I guess you're going to tune in a little bit later. Thanks for watching. Thanks for the question, by the way. But would like your thoughts on hedging Apple into earnings. And by the way, same thing, folks. I mean, if you are unable to make a live stream but have questions, whenever you think, send in your comments, and we'll try to get them in here and respond to it. Okay. Hedging Apple. First things first. What are we hedging against? Right? So I'm just assuming that the presumption here is that you are in a long Apple position. Can you use options to hedge it? Short version is yes, you can. What am I going to ask myself as I look at the event? The first thing I'm going to ask myself is, are options expensive or cheap? If options are expensive, I'm likely to pursue a strategy that is slightly different than the one that I would choose if options are cheap. Right now, the options market is implying a move of about 3.7%. That's the one-day move. The straddle, I already looked at this, by the way, because I was looking at it for another reason before we started this. The straddle that expires on Friday is about 4% of the current stock price. That's about the average move. So options are not overwhelmingly expensive going into the print. They are fairly priced. They're not cheap, but they're fairly priced. So if you think that the average move is probably representative and you're concerned about that downside and you know that options are fairly priced, you could just start there. So I own Apple and I could say, all right, well, I want to buy, just trying to hedge through today's or this week's number, because they're going to be reporting tomorrow post-close. You could do something really cheap, try to pick up something close to the at-the-monies, 170s, those are slightly in the money. Maybe you go out to the 167s, trade a near put spread. Implied move to the downside, so spot 96, 169, let's call it. Let's say the downside's 162.5-ish on the implied, so that's right here. And there you go. So that would be the simplest way to do it. One-day move. You're going to lay out $1.50, so that's less than 1% of the stock price. Pays you 3 to 1 almost. That's kind of the math you're kind of looking for. What else can you do? You can use a put spread collar. A put spread collar is something I favor more. If the options I really thought were overpriced, then this would be something I would favor more. You want to sell more options when you think they're really rich. It's implying the move that it has averaged, so they're not really rich. And then take a look at the way stocks are behaving, right? So they're not really rich. But I'm going to do this for illustrative purposes, not because this is actually the trade that I would necessarily recommend. So you could say, all right, I'm going to sell the 175 calls, give myself a little bit of room for capital appreciation of, in this case, a little over $5. Stock was 169.30, so I give myself some upside room to 175 by the end of the week, and essentially offset almost all of the cost of that trade. And then if you add the stock in here, now we see what this looks like. By the way, people who have seen me do call spread risk reversals in the past will recognize the shape of this trade, because a call spread risk reversal and stock hedged with a put spread collar are, again, synthetic equivalents of one another. But to be clear, this is not the trade I'm recommending, because I don't think options are expensive, so I don't want to sell more of them than I would be long. If your objective is to, I'm going to just get rid of the stock here really quickly and this 175 call, to bear that hedge out a little bit longer. So you weren't able to join the live stream. I don't know, maybe you're on vacation. So you're thinking, I'm going to put a trade in and I want to have this thing last for a little while. You could actually stretch that out a little bit further. If you go further out in time, though, I would probably push the strikes out a little wider, because in that case, the more time you give a trade to take place, the more this underlying stock can do. So I would probably push out the strikes of that put spread a little bit in that case. Okay, let's see here. This is interesting. Rye Mocha asks, do you see Whirlpool is at the bottom? I'm actually kind of curious. Were you watching Fast Money yesterday? Because you know who was talking about Whirlpool, I believe, yesterday was Tim Seymour. And Tim Seymour, I think, was looking to Whirlpool as his sort of housing play. That was kind of the way he was looking at it. Is it at a bottom? Well, unfortunately, I'm not sure I have a really good answer for you there. I'm not sure why this would necessarily be a bottom. I'd like to see some sort of measure of support. I guess we're getting down close to these pandemic lows right in here. Maybe we can pull this chart up. You can sort of see what I'm looking at. So this is a long-term chart that we're looking at here. If that's what you have an eye on, this is round numbers, by the way, because it was actually lower. So if you're kind of thinking round numbers, do I actually think that the pandemic trough could actually represent a potential opportunity? Yeah, I think potentially it does. Durable goods, kind of a challenging spot if you think about it from a consumer point of view. A little bit stretched. One other quick point I would like to make about Whirlpool does carry a decent bit of debt. It's actually more debt than equity. So it's about a $5.2 billion market capitalization. It's, $12.6, $12.7 billion enterprise value. So essentially, if you say, okay, well, X cash, what's the whole company? If I wanted to just pay outright to buy the company, excluding any net debt or cash. So I'd pay off any debt and not including any cash. That's sort of the way to think about the value of the business. The implications for this are when you have, the more debt you have, the more volatile the equity would be, right? Makes sense. So it's just a way that you introduce leverage to the equity. It's not unreasonably valued on that basis. You know, figure 12.5, 13 bucks a share on 94 bucks. The problem is you've got a declining top line. And what did I say early in the show when I was talking about Starbucks, why I wouldn't add to our position, even though I pointed out that the thing is cheap relative to its own historic multiples. And the reason is I just don't back up the truck on anything that is either flat to declining. Because that's when you see cheap stocks get really cheap. And you're going to make a lot more money picking up companies that are growing faster than the economy in the long run, almost no matter what valuation you pay for them, than looking for cheap stocks that are getting cheaper. I think this is what Charlie Munger referred to as the cigar butt strategy. It was something that Warren Buffett was known for early in his career, that he would go and try to find stocks that were trading at single-digit multiples. And, Charlie Munger said, you're basically going around and picking up used cigar butts off the sidewalk and trying to see how many last puffs you can get out of them. Buy good businesses at reasonable prices rather than looking for impaired businesses that otherwise look extremely cheap. Because there's another reason why they look cheap, and that is because I think a lot of times you have analysts who, I'm guilty of this, I think we all are, is that when things turn south, you almost can't believe that it could really be as bad as all that. So you just have this natural assumption that things are going to, improve, get better, or normalize. We have a pretty ugly economic data. We have, tested consumers. It's a struggle. I don't know that it's quite at a bottom yet. It's cheaper, but is it cheap? I don't know. I apologize. I wish I had more to offer you. It's not the kind of stock that I would rush out and buy because, like I said, declining top line. If you own it, though, some of these other strategies I was talking about might, some of those might make sense. Okay. What else we got here? So, Block, aka Square, view on the May 68.75.17. I assume that's a call spread. So I just punched that into here, and we will take a look at that. Let's take a look at this. May 68.75, the May regs. So 68.75. These are the calls. So that is this trade right here. And let's just take a look at what's on the docket. We've got earnings coming up on this. Geez. Earnings are tomorrow after the close. Okay. So this actually is a perfect example of what I was talking about before. How do I feel about this trade depends a great deal on whether or not I feel like options are expensive or cheap. So the long-term average move on earnings for Block is, and now I'm just talking about the one-day move, it's a little over 8%. Right now, and for those who aren't used to this, but we're just going to go through this exercise, it's not going to take much time. We're just going to quickly take a look at the weeklies. We're going to take a look at that because I was about to just pull it up on my separate machine here, but you guys might as well take a look at this. So what is the implied move? We're just going to take a look at that at the money straddle, and you can see that it's trading for 838. That's with the stock at just about 67 bucks. 830, yeah, so that's pretty chunky. You're looking at an implied move of over 12% going into it. So what did I just say? The long-term average move is about 8%. The straddle is pricing in a 12% move by the close of business on Friday. So first thing you would say is, wow, those options are really expensive. When I see something like that, I then will try to hone in on it a little bit more and say, well, why is it so expensive? Well, one of the reasons is when they reported their Q4 23 earnings in February, the stock was up 16%. It was up 10% the quarter before that. It was down just under 14% the quarter before that. So yes, the very long-term average move is about 8%. But more recently, 3 out of 4 have been double digits. So actually, they're probably pretty reasonable. So the short version is, if you're bullish on Block, and the stock, I mean, it got absolutely tagged today. This is another one. But if you're bullish on the stock, I would much rather have your call spread on as a way to make a bullish bet. So just pulling this back up. There we are. Probability of profit is not that great. Why isn't it that great? It's about 35%. The reason it's not that great is because there are 3 things that the stock can do between now and the expiration of this call spread. It can go down. It could pretty much stay where it is right now, or it could go higher. And in this particular case, it has to go higher by at least the amount of premium that you're spending, which in this case is about $2.30 a share, for it to see profit. So that means it has to be above the $68 strike that you have by at least $2.30. That means you got to be at $70.30 as of May expiration. You know, round numbers, you know, it's got to be, you don't even start to see profits until the stock is up at least 5% or so. That said, with these kinds of moves and this kind of price action, and especially the kind of price action we've just been seeing out of a lot of these stocks in general, right? A lot of these could have support down here around 62.5. But yeah, I think if you're going to make a bullish bet into earnings, I don't have any position in Block for what it's worth, but if you are going to make one, that's a decent way to do it. Here's the flip side, right? So think about it this way. That call spread risking 3.4% of the current stock price. I mean, the stock was down 10%, not 10, 9% today. So yeah. What else we got here? I should probably expand this thing a little bit so I can sort of see what's going on. By the way, yes, if you have any questions, if you want me to talk about a stock that I have not mentioned, then please put it into the chat. Here's a name we don't talk about too often. Okay. This is Hewlett. This is the enterprise side. Where was that question? I just had it a second ago. There it is. Hewlett, this is the enterprise side, is down today. Sell products to NVIDIA like servers with AI. Last earnings backlog was $3 billion with NVIDIA products. So yeah, this is kind of an interesting situation too. I kind of feel like this is another example of what is going on, you know, that we saw with AMD, right? So even okay news is, you know, just not a reason to buy a stock. You know, everybody's turning seller. AI is definitely a potential, you know, it's basically a growth area for Hewlett, which doesn't really have that many other than that. Problem is, and this is actually really what I think people got upset about in the AMD case. It's just that everybody wants these results right here and now. And that was what NVIDIA did so effectively. Think about it. Every single time you went into earnings, people had these really ambitious growth targets and they would just blow the doors off. You know, you just almost couldn't believe that something could grow that fast. In AMD's case, whether it's supply constraints or any other reason, but people want to see this AI growth here and now. And part of, I think, one of the reasons for this is that they know there's massive investment going into the space. And if you're not demonstrating that you're capitalizing on it right now, it's not just an issue of a dollar delayed. I think it is also an issue of investors wondering whether or not that opportunity truly exists for you. Why is that? Because management, recognizing that AI was this big boom, just like when crypto was all the thing and the blockchain, everybody wanted to mention blockchain when people began to recognize what it was. And you just heard it on every call. So when AMD first started mentioning AI, is this just a play to try to capitalize on that theme? It is clearly a theme for Hewlett. It's clearly a theme for many. Right now, the concern, and I think it's a legitimate concern, is that some AI ambitions at some of these companies may take longer than it will at others. NVIDIA and Supermicro, which was down pretty sharply today, by the way. We don't. Okay. So I don't know if that helps you on that. Let's take a look at this question. What do we got here? After the Fed meeting, should I adjust the 503.478 put spread expiration 517 on SPY? This I like this question a lot. And actually, what's interesting here is I don't know when you put this on, but the short version is yes. And actually, this is good because I've gotten this type of a question a few times. When do you adjust things? All right, so we're going to just bump this to the appropriate expiration. So you have the May 17th, and this could be an outright bearish bet, or it could be, let's see here. All right, so here's that put spread. So what do we like about the put spread just as you hold it right now? Well, first of all, we got we got the news from Powell that we liked, and the market rallied and then sold off. That price action's not great. The reaction I'm seeing from single stocks coming out of the news, good news or bad, it seems like we're just getting punished. That doesn't seem great from a risk-reward perspective. I still think that the premiums on the index complex in general, like I said, I usually use SPX, but SPY is just as good. Maybe it's easier for you and you can size it relatively easily. And maybe sometimes it has just more, I think it's more intuitive for some people. I know a lot of professionals who actually think about the market in terms of SPY prices. People who've been at this for a long time and they're just like, what is fair value again? They struggle between the cash and the futures. But so when do I like to adjust it? The thing about having options is that I like to have a little bit of convexity. So if you put this thing on when it was a little bit higher today and it's already run through your 503 strike, so you can't really do anything with this right now, but tomorrow, let's take a look. So I have said that generally when I get up to about a 60 delta, it's time to do something, whether I'm short an option or long. And this is close, right? So this is a 54 delta option right here and now. The 505, it's just $2 higher. Those things are a 60 delta. So essentially, if SPY moves down another 35, 40 base, we'll call it 40 basis points. S&P falls 40 basis points tomorrow, which is easily imaginable. That's going to be a 60 delta option. You want the benefit of convexity, and there's two things you can do. You can either just take this and roll it down, and what would I roll it down to? I'd go to probably the first out of the money strike, but bear in mind it's going to be different. But let's say we were doing it here and now. I would probably actually even be thinking about being long the options that you are currently short and moving further down from there. So, oh, not the 478s. I'm sorry, you're down to 478. So you chose a good out of the money strike. But I would probably roll the long strike down, to something like the probably less than 40 delta. I want to get a little bit of convexity out of that. So I will frequently try to upsize the position and I'll trade my deltas around. I might get something like a 30 delta option, but you could get the 495s, 495, 475, and you could get a little more of it. So it's going to look a little bit like that. Wait and see where we open tomorrow. I mean, I think, like I said, this 503 strike put that you currently own could very easily be north of a 60 delta tomorrow. 40 basis point decline in the S&P, you're going to be right there. Okay. Let's see. Do you have an opinion on RILY earnings? Admittedly, not a company I really follow that much. And one might think, oh, you know, aren't you in financial services? And not on that side of the business, actually, so much. So haven't really paid a whole lot of attention to them, admittedly. But, I mean, why don't we just take a look at some of the things that I would start to look at if I did. I wish I was a master of all stocks. I am not. Oh, we got a nice, interesting little bump in there, huh? Just recently. What was that? What happened there? So you obviously got some kind of news in here. Let's see what that was. That was on the 23rd. Let's see what happened on the 23rd. Let's see if I can get this thing to work. All right, so let's go back to the 23rd. Was there any meaningful news that came out right then? That's just what they were doing. They got hired by my former employer. I used to, for those who don't know, I was a canner. Looks like they were doing it. It seems like that was the only major news at that point. What kind of valuation we got here? All right, so you got a $1 billion company, $2.2 billion. This is a financial, so I actually have to understand their balance sheet better. Enterprise value doesn't really, it's not, don't take a look at a bank and start looking at things like enterprise value. It's a little bit more complex than that, but you can look at book value. So $1.73 a share, that's the trailing 12 month. That was their full year numbers. That was down. Looks like we have decent top line growth. 33 bucks. It's cheaper than the market, but the financials typically are. Nobody really covers this thing. A little bit of free cash flow. I don't know if they carry a lot. What's their balance sheet look like? All right, so I just got some insight that the bump that they got back on the 23rd, the news that I had not seen, was that their auditors had signed off. Let's see, when was that? Who is their auditor? Let's see if I can find this. Yeah, let's see. Audit risk may have potential rewards. Okay, so, oh, I see what's going on here. Earlier this year, okay, so for those of you who are watching at home, so, and again, I apologize, not a company I follow, so we're all kind of learning about this together. Earlier this year, they warned that they were not going to be able to file their annual report on time. Now there is a company that we have had positions in that I have followed, ADM, had a similar situation. And of course, this is the last thing any investor wants to hear, right? That accounting irregularities. They got an auditor to sign off back on April 23rd. That's the reason they got that boost. But they did cite that there were continued risks. and they had to restate a bunch of past, we can see it here. So they had to restate a bunch of their past financials based on some accounting errors. The good news is that usually when this kind of a thing takes place, you can get a situation where people will kitchen sink the situation. So especially if the people who are brought in to solve those issues were not in any way responsible for what caused them in the first place. Because you basically want to get everything out in the open and start with the lowest possible bar to step over that you can. So that's the good news. The bad news was the auditors cited that there was still considerable weakness in their financial statements, that sort of thing. So I don't have any really great insights for you on this one. I'm sorry on this, although it would appear that this certainly doesn't look very good, what's happened today. It does appear, just from a technical level, like buyers kind of queue up around the 20 level. That's a pretty significant discount to where we are right here. Whoa, my goodness. I just realized what time it was. Way, way longer than I usually go. And I apologize because that is always my habit. I'm always curious to hear what people have to say. So the SPY trade, I hope you guys got that answer. They finally filed, so that was the question. Company received a standard notice of non-compliance. So Don Huddleston was just offering some insights on RILY. It seems like you know a lot more about this company than I do. Perhaps at some point we'll have an opportunity to talk about it. Not one of my biggest bits of expertise, though, with B. Riley. I'll do some homework on it, and maybe I'll be able to have further insights in the future. All of you, thank you very much for taking all of this time to hear me yammer on and commiserate about Starbucks and AMD and all that kind of stuff. AMD has their general meeting next week on the 8th, noon, West Coast time. So if you're in the name, you may want to pay attention to that. That's another potential catalyst. Probably a positive one. They always tell a pretty good story. Thank you very much for watching. Like, subscribe, and tune in for the next one. We're going to do this again next week, Monday, 4:15. I'll see you here.